seeing all the, everything crashing around me and everything collapsing around me, that really is, I'll never forget that. And that's really part of my love for apartments right now. It's really based on how they saved me during that time.
Welcome to the Apartment Investing Journey, where we explore every facet of multifamily investing and development with top investors, brokers, and service providers who share their strategies, successes, and secrets to help you on your apartment investing journey.
Hey guys, welcome to the Apartment Investing Journey. I'm David Robinson. I'm joined by our guest today, Tim Watcke. Welcome to the show, Tim.
Hi, thanks for having me.
Yeah, my pleasure. Well, look, I appreciate you taking the time to come on today, and I'm really looking forward to our conversation. But before we dive in, a little bit about Tim. Tim is a professional real estate investor, developer, and broker residing here in Salt Lake City, Utah. He and his companies operate and manage a large commercial and residential real estate portfolio. Tim has over 26 years of experience and specializes in buying, selling, leasing, construction, and value-add renovations. He's personally purchased and sold over 400 properties and flipped over 200 homes. He and his companies excel in the acquisition and development of multifamily apartments and mixed-use properties. He recently finished a brand new 86-unit apartment building and has 69 new apartment units currently under construction, along with another 49 units under remodel in Salt Lake City as well. So, Tim, with all that said, if you don't mind, to give the listeners some context, do you mind backing up and just telling us more about your story? You were born and then what?
Sure. Yeah, I was born in Detroit, and suburbs of Detroit, and my father was a college professor, and he saw an infomercial somewhere. This was way back in the 80s, probably early 80s, about flipping homes or real estate, something of that matter. And he ended up buying a flip, his first flip as a college professor when I was 8 years old. And the whole family was involved, and my older brother, myself, and my mom, we all were involved working on the home. And my job was mostly, I was in charge of stripping the lead-based paint off of doors and trim with a heat gun. And so, yeah, we didn't know at the time that was probably not the best idea. But fast forward a bunch of years, all throughout the summer, my dad was still a college professor, but also he started to buy more and more properties. He never really sold money. He mostly was a buy and hold forever kind of guy. He then started buying apartment buildings. During that time, when I was 16, I bought my first duplex with seller financing. It was only $40,000. It was in Ferndale, Michigan. It was a $7,000 down payment, and the rest was seller carryback. So that was when I started. Moving forward in college, I built some spec homes, accumulated a couple more rentals here and there. And then I graduated college, and I moved to Park City to be a ski bum for the season. And that was 20 years ago, almost to the day. So needless to say, I never left. I'm no longer a ski bum, but I was supposed to, after the ski season, for the one season, I was supposed to go back and work with my dad in Detroit. And needless to say, that didn't happen. I stayed that was in Park City. Now I live in Salt Lake, but after I decided I was going to stay for a little bit, I was a waiter during the waited tables during the night, and I was working on flips and rentals in Salt Lake City. I would work all day, doing everything from painting to carpentry to buying and selling. And I got my real estate agent's license, and this was in the early 2000s. And at night, I'd wait tables. And then finally, I was doing enough volume flipping that I quit the waiter job. And I just started doing flips and accumulating single-family rentals exclusively. But in 2006, it got really, really competitive with flips. And I was a young guy, and I didn't really have many connections, and I didn't know too many people. So I was pretty much buying off the MLS. And it was getting really hard, and everything was getting bid up. Owner occupants were bidding up everything, and everyone was bidding up everything. So it was really hard to find any kind of flip that had any kind of profit margin. So that is when I started buying apartments in Salt Lake City. I never really thought about owning multifamily before, even though I really grew up in it. But that was when some multifamily not really fell in my lap, but I became aware of some of it. And I thought, well, let's do this because, the residential flips are getting annoying and hard to find. And then I was thinking, well, I'll just flip a multifamily, because for some reason I never really liked tenants that much. So I never really wanted to own and have too many tenants, because I grew up, with my family business. I grew up with a lot more negatives of tenants than positives, and just kind of the never-ending property management headaches that you always hear about, the 3 T's, the toilets, termites, and trash. So, and I think that really tainted my view for a while, but I'll tell you later how that's really easy to fix. So anyway, I ended up buying some apartment buildings, and those are supposed to be flips. Well, lo and behold, the Great Recession came, and there was no buyer for those flips, my apartment building flips. But the good news was they were 100% full, and my vacancy or my occupancy during the recession was probably 98, 99%. I mean, mind you, I was doing a lot of the work myself. I was leasing and, in charge of, electrical, plumbing. I was the attorney. I was the accountant. I was the property manager. I was doing a lot of stuff. But, it really kept me afloat. I mean, a lot of other people I knew that were in the real estate business in one way, shape, or form filed bankruptcy or lost everything, or, they were spec home builders. Everyone was a spec home builder, and everyone lost a lot of, lost their whole life. So, and it was, for me, having the apartments, it was really, really, it was the opposite of that. So, even when it's dismal and everyone's losing their job, people always need a place to live. And if you can provide decent, reasonably priced, decent, working class housing, there's always a demand for that. Coming out of the recession, flipping was getting better, and I had some really good years of flips. But then I realized all I had was just a good job. I had a really good job, and I don't want to complain about it, but it was getting old and tiring. And every month I had to find 2 or 3 homes, and I had to sell 2 or 3 or 4 homes, and that just got exhausting. I still have my apartments. I actually sold a bunch there. I was able to sell some, and I paid off a bunch of debt, and kept flipping. And then I realized pretty quickly that when I don't own apartment buildings, 2 things happen. I pay a lot more in taxes, and I have to work a lot harder every day, all day. So I realized that I really want to focus more on apartments. Pretty much stopped the flipping. I don't do any residential flips right now. Occasionally I'll flip a small multifamily, like a 4-plex or a 10-plex. But now my main focus is building new multifamily and mixed use, and renovating and doing value add remodels on existing multifamily.
Well, I'd like to dive into a few things that you discussed. The first is this concept of flipping apartment buildings. Not a lot of people correlate the word flipping with apartment buildings. They, for the most part, think single-family home. Describe to me,
right,
and to the listeners, how did that concept even enter your mind, and what does that even mean?
Well, it's really similar, just like you said, to a single family, but there's just multiple doors. And these are usually smaller ones than 4 units, 10 units, 16 units, 12 units, things like that. And often we'll complete a gut remodel, all new electrical, plumbing, everything. Spending $50,000, $60,000 a unit to get them remodeled. And usually, what happens often, I buy some of these properties and I expect to keep them, but then an offer shows up that I can't refuse, and I say, I'll accept an offer. So lots of times I don't even list them, but I'm usually pretty much almost everything I'm buying recently, I'm intending on keeping, but then between the remodels take 6 to 12 months on some of these buildings because they're fully permitted, and pretty in-depth remodels are usually older, 90, 100-year-old structures in Salt Lake City. So they take a long time, and just during that time, something changes or someone's interested, and I work with a bunch of brokers, and they ask, do you have anything? And I say, I bring up something that we're remodeling now, and next thing you know, there's an offer on my desk. So, but really, there's not too much different other than typically they're more expensive. And really, to get the top dollar on the resale, we always go in and really work on the non-cosmetic stuff, the all new HVAC, all new electrical, all new plumbing. And then when we're trying to sell something, we get tenants in there, and we sell a turnkey property with tenants already in place, a building that there should be no capex expenses for a long time because everything's brand new. And it's ready for an investor that wants to be a little more hands-off and just step right in and start making money. Sometimes when we sell these, there's already property management in place, not by me, but a third-party property manager. So really, someone can make real estate apartment owning. It's supposed to be passive, but it's really only passive if you're buying essentially a turnkey property that's managed by a manager. Otherwise, it's anyone who's owned any property and self-managed, they know it's anything but passive.
Right. So is it fair to say then that these apartments that you flip are highly distressed when you go in and acquire them? Okay.
Yes.
And you mentioned the construction process taking, potentially, 12 months to complete. Mm-hmm. And I assume there's tenants in place already, at least to a certain degree. And so walk us through what that process looks like.
Yeah, and it depends. I bought some buildings that were empty. There's a 12-plex that comes to mind that had one occupant in the whole building. So that was a lot easier than other buildings that were full. Depending on how the leases expire and if people are month to month, we'll give notice as required by law, and end some of the month-to-month leases, and or when leases are up, just give those people notice that we're not renewing. You have to leave at the end of your term. So that's usually what takes the most time. We've done it both ways where we've remodeled. It's a lot easier to remodel an empty building, but sometimes we don't have the choice if there's just leases, and we bought people out of leases just so we can get an empty building. So that part really depends. But then, the permitting takes a couple months usually. Then the heavy lifting and construction takes, 3, 4, 5 months, and then a month to get it re-tenanted and all that. So, when it's all said and done, it's usually, a quick one would be 6 or 8 months, but usually it's a lot longer. So
that's great. And
the value, go ahead. Okay.
Yeah, I was just going to ask about that. I was curious, when you're purchasing, what cap rate are you purchasing at, and what are you selling at?
Right. So that's a good question. And that's all that matters in multifamily. It's the value is based on income. So that's the golden rule. So most of the things I'm buying, they're usually it's both. They're trashed and under rented. And I guess I don't know which comes first, the chicken or the egg, but there's something distressed about them. And they're not always horribly distressed physically, but just maybe haven't been updated in 30 years or ever. And the rents are $800, and with a remodel, those rents can be literally double, $1,600. That's the kind of deal that I'm looking for. And one I just did recently was an 8-plex, and those are the correct numbers. It was $800, all 2 bedrooms. They were $800 a door when I bought it. By the time we were done, now all 8 units are rented today at $1,650 a door. So, literally doubled the rents, and you could argue the value more than doubled because I bought it at a slight discount to market value, even with the in-place rents. So on the multifamily, it's all about how can you increase the value, and where the number of doors matter. Increasing the value on a 4-plex, $100 or $200 in rent per door per month. That's great. That will add $100,000, to the value, $200,000 to the value. But if you could do that on a 50 unit or a 20 unit or a 40 unit, all of a sudden getting a couple $100 a month more per door, can literally add millions of dollars in value. So that's why, the bigger, I guess it goes without saying, but you don't flip a 10-plex if you could flip a 20-plex or a 40-plex. So,
right.
But then those obviously are harder to find, harder to purchase, and cost more. But to get that economy of scale, since everything is valued based on the income, and that's it. If you could figure out how to increase income and decrease expenses, and get a net NOI, a positive NOI growth. I mean, that's how you make money. Yep. And then even if you sell, so that's the key to selling, but also that's equally as important to doing the BRRRR method and to refi, because in order to refi and get all your money out, you need to get a nice high value, and you can probably typically get about 70 to 75% LTV. So, and again, the appraiser is going to base most of that appraisal is going to be based on NOI. So, a little bit of other comps, but really the comps are usually based on cap rates, not so much, a little bit based on location, obviously, and type, but really it's appraisers are looking at what's the market cap rate for this specific product, and what are the rents, what's your income, your NOI today, and that's usually how the value comes up.
Well, and that's the wonderful thing about commercial multifamily versus your single family homes, where
yes,
the market appreciation or what the next door neighbor's home sold for or didn't sell for could have a positive or potentially a negative impact on your value.
Exactly.
The commercial valuations are all strictly based off of ultimately the net, the financials, the NOI.
Yep, because it's almost like you're buying a little business, and it's this little self-contained little business. So that's why it's valued as such. Yeah, you're right. Not based on the house next door.
I do want to talk about this time in your career where you were flipping a lot of homes, and then the recession hit. And you mentioned, I believe that you said that during the recession, one of the reasons you were able to stay afloat while lots of people around you were failing and falling out, losing everything, was your apartment buildings, and the fact that they stayed,
Correct.
I believe you said 95% occupied throughout the entire thing without even lowering rent. So this is, I think, something that a lot of the listeners will really appreciate. And so if you don't mind, maybe go into a little bit more detail about that time in your life and how those apartment buildings helped you.
Yeah. I mean, you hit the nail on the head. It really just having everything occupied and everything. I mean, the mortgages were low, payments were low, and the cash flow was coming in. And I wasn't worried I didn't have to sell a flip. I didn't have to find another flip. I didn't have an employer laying me off. And people always, these were at the time, most of these were in the $600 to $800 range for monthly rents. And I mean, they were full, very little turnover. When I had turnover, they were rented in a day or two. I mean, it was definitely a good time to be a landlord. And I seeing all the, everything crashing around me and everything collapsing around me, that really is, I'll never forget that. And that's really part of my love for apartments right now. It's really based on how they saved me during that time.
So I think that's an important story for people to understand because we are coming at least near the top of a cycle. There's a lot of different discussion about where we're at in that cycle, but I think it's fair or safe to say that we're nearing the top or at the top. What are your thoughts on the market in general as far as apartment buildings are concerned? And give me your thoughts on it. If
we're just talking about Salt Lake City, I mean, that's definitely my specialty is Salt Lake City, and the state of Utah in general. I mean, there's a lot of building. There's tons of new product coming on the market every day, and I'm adding new product. I'm building ground up buildings also, but Utah is growing so much, and I know depending on what stat you're looking at, our vacancy has been around 3 or 4%, depending on where you're looking. Even if our vacancy goes to 5 or 7%, that's still okay. That's kind of normal and healthy. So as long as you're underwriting, so to answer your question, what do you do? If you're underwriting with a reasonable vacancy, and let's call that 7 or 8%, and the deal still works, then that's a good deal. Because you can't just, a lot of people say, I'm going to wait for the market to crash. Like, well, if you're buying apartment buildings, it doesn't really, I mean, unless you're already buying apartment buildings, you can't just wait for the market. When is that going to happen? When the market crashes, I mean, everyone, if it crashes, everyone's going to be afraid to buy. All those people that say, I'm going to buy when the prices get down, when is that? And I would almost say, no, you're not. You'd be too afraid, because, and also banks aren't going to lend you, oh, you've never bought, you don't own any real estate or own apartments, and now it's another recession and you want to buy now, no thanks. They're going to pass on that one. But if you're already buying, buying when it's good, buying when it's bad, I mean, you have to start a track record somewhere. And it would be pretty unlikely that a bank is going to finance you starting your apartment investing journey in a recession. So those are some things to keep in mind, that, timing the market, that's always done in hindsight. It doesn't matter if it's stocks or Bitcoin or apartment buildings. It's easy to say what you should have, coulda, woulda, and didn't do. So,
that's great
and
advice.
I would say, I mean, now in Utah specifically, I mean, our market is so strong. Our job market is so strong. Our job growth is so strong. I mean, relatively speaking, we're in a pretty good spot here. So, and I'm buying. I mean, I have no, I'll buy in good and bad times. And again, I think the key is that make sure that it cash flows today and make sure it works. The deal works without appreciation. So, I used to buy flips, and I'd say it's okay. By the time I'm done with the flip, the appreciation is going to, make me my money. Now that worked, but that's a really bad habit to get into. So, I don't like to look at an IRR calculation, because an IRR, internal rate of return calculation, factors in what the property is going to sell for, in 5 or 10 years or whenever you sell it. And that's just a wild guess. So I look more on cash return. And, if you get some appreciation, that's great. That's icing on the cake. But, everything I own now, if it didn't appreciate 1 penny in the next 10 years, but all the tenants have paid off my rent, paid down my mortgage, and, and I made cash flow, I mean, that's a huge win, even if it didn't go up a penny in value. Because remember, you want to outsource your debt obligations to your tenants. And, you wake up in 10 or 15 years and, a tenant essentially has paid off, the house or apartment buildings for you, while you got cash flow and tax benefits all along the way.
Man, great advice. I'm interested in what you're experiencing on your cash on cash returns right now. What are you looking for in a deal?
It's a good question. I do a lot of 1031 exchanges now. When I am churning, a lot of these flips, I am able to flip apartments. Usually I'll own them long enough, and they'll fit in the 1031 exchange guidelines. So I am exchanging a lot. Therefore, I'm able to put down a bigger chunk of money than I normally would, because I'm putting down more than 30 or 40%. But, the cash on cash when I get in is not very good. But fast forward 8 months, 12 months, when I complete the remodel, spend a bunch more cash, complete the remodel, and then refinance, get all of my cash back and then some, usually another couple $100,000, depending on which the property, maybe even $500,000 out, on top of all my initial investment. Then my cash on cash, I know it sounds kind of corny to say it's infinite, but I have zero
really
money into the property,
right?
And we'll say it's infinite. So it doesn't start out that great, and I don't look at that. I'm bleeding money for the first 6 to 12 months, but then when that big refi comes through, that's and the beauty of refinancing is there's a couple funny slogans my dad used to say. It was, one of them was refi till you die, and he's had properties for 30, 40 years now, and they've been refied 10 times, 15 times, every 3, 4, 5 years, refi it, take out, 20, 30 grand, but in the case of an apartment building, every 5 or 10 years, take out $500,000 or $1 million, and that's tax-free, and the non-taxable event, tax-free, roll that, leverage that in the next thing, pay off other consumer debt. I mean, there's just so many, that's really powerful to get that money in this, on some of my new construction buildings. I mean, that's, again, I've been bleeding for 2 years, but when this refi comes out and I get all my construction costs back and then some, I mean, that's
then
more
you're playing with house money.
Yes, exactly. And the tenants are still paying off the mortgage, and still get the tax benefits, and when you can do that, it almost makes some of these bigger buildings, like I don't know if I'd ever sell them because, I just refinance them, and it's hard to sell them when you have the ability to refinance. As rents go up, and even if cap rates go up a little bit, rents will go up. So value should, I don't see values dropping. And again, like we talked about the recession, if the recession comes, unless rents crash, there's really apartment values aren't going to really move. If rents stay the same, the values of apartments will be the same. And there might be more of a demand of people wanting to buy. There's a huge demand right now of people wanting to buy apartments. If there's a big recession, there might be a flight to safety, and people are going to think apartments are safe, in which they are. They're going to sell their stock portfolio because they just got hammered. And now these boring 4, 5, 6, 7% cap rate, or 3, 5, 6, 3, 4, 5, 6 cap rate buildings, all of a sudden look pretty nice, compared to a minus 30% on your stock portfolio.
I know I've kept you longer than we had planned. I appreciate your time, but if you don't mind, let's switch gears and let's talk about a specific deal. I think you had mentioned a deal out in Tooele that you had recently acquired.
Yes. This was a syndication deal. A partner, a friend of mine, kind of a guy I do some work with, he brought the deal to me. It was a 42 unit in Tooele, and it needed a lot of work. It was a couple things, kind of what we talked about earlier, that condition and under rented, and this had both of those going for it or against it, depending on what side of the coin you're on. But it was an out of state seller, really bad, really poorly managed, and undervalued, and lots of deferred maintenance. And the building had really good bones, and it's a really good looking building, but just all been tired and poorly managed. So what we did, there was myself and a co-sponsor. We did a 506B private placement memorandum, and we raised $800,000. So it was a syndication. We raised $800,000. We had 7 other limited partners. So there's 2 of us were the general partners. General partners or sponsors. We raised $800,000 from 7 other people. We got a loan from a local credit union for the purchase and for the remodel. The remodel was about $600,000 or $700,000. Every unit was remodeled, all new HVAC, flooring, kitchens, cabinets, all the common areas and hallways. Really shined it up a lot. Turned out where there's a buyer right now. So this is about a little bit more than a year ago. There's a buyer right now, and this should close in a month or 2. When it does, the limited partners, they'll all realize a 30 to 40 or so % IRR. And there's that IRR that I don't like. But
wow.
This one, since we know the exit price, they're all going to make a 30 to 40% or more return on their money. And then me and the sponsor are going to make a good chunk of money too. So it was a good way. Syndications are nice. It's a good way to kind of bite off more than you could chew, because you're not, you're kind of using other people's money. And that's another golden rule in real estate is the more OPM you can use, the better other people's money. So, it was a good experience, and it worked out really well. And in a month or so, this thing will go full circle. And all the investors will get paid. And I'm sure the second they get paid, they'll be asking me what I have next.
Yeah, ready to reinvest. So if I could break that one down. Yep. So it was a 42 unit in Tooele, under-rented, distressed, needed quite a bit of work done, poorly managed, under-rented. You had 2 general partners. You had 7 limited partners, which you raised $800,000 from for the purchase, and you had about $700,000 in remodel. Exit, your investors are going to experience around a 40% return. Can you give us an idea of what the rents were when you acquired the property? And what you were able
the rents were in the probably 5 to 800, and now we're in the 800 to 1200 range.
Wow.
And then there's a bunch of additional, when you get to these bigger buildings, when there's some scale, the additional income really adds up. If you can get, another $30 a month for common area maintenance and another $90 a month for internet, things like that, you're getting an extra couple $100 per door, times 42 doors, that actually moves the needle a lot. So we got internet installed in all the buildings, and we make it mandatory. So to rent there, it's mandatory that you have to buy the internet, and it's a fair price. It's a good quality internet, good speed that is equal or lower in cost than if they just called CenturyLink or Comcast directly. So tenants, no one pushes back on that, and everyone's doing that now. So I mean, any building of size, you can expect that. So just do what everyone else is doing. There's no reason to recreate the wheel. But that's another good way where just by making the spread, if we're paying $20 or $30 a month for the internet and we're selling it for 80 or 90, just that spread right there times 42 units, that's a huge chunk of value. So
yeah, that's significant.
Just by doing things like that. And then the management, just getting the better management in play. So.
And how many of the units did you turn over during your ownership?
All of them. And this one, we never really broke. We're always about 40%, 50% or more occupied. So that was there's some challenges there, but it's hard to work around other people and other people's apartments, but we actually made it, we made it work. It would have been a lot easier if the whole building were empty, but that also means we didn't get, 40
didn't have the cash flow.
We didn't have any cash flow. Yeah. So it depends. I mean, if you could get a loan or put it in your numbers that the building is going to be vacant, that's definitely better. Sometimes the banks might freak out if you tell them, hey, we're going to have a vacant building for 12 months. They're not going to like to hear that. So, you might not want to really, you might want to downplay that a little bit, but it also, it ended up working. And now we finished all the heavy remodeling around Christmas. And since then we've been 90%, 95, 98% occupied. So now it looks good for resale. And, the party who's buying it, they have their third-party reports are happening now. Appraisal's happening soon. So, we should be, we're on our way to closing, but we're still probably 30 days away.
Well, congrats on a killer deal. That sounds like a great project, and the outcome sounds like it's going to be excellent as well. So good on you.
Yeah.
Well, look, Tim, I really appreciate the time that we've spent together. We've covered a lot of ground, but we need to start winding down here. I've got 3 questions for you about your apartment investing journey that I want to get your just knee-jerk gut reaction to. You ready?
Okay, go.
All right. What is the biggest mistake you've made during your apartment investing journey so far?
Waiting too long to go big. Messing around with small things when it wouldn't have been much harder to add a 0 or, add another 20 units, and messing around with single family for too long.
What's the biggest win you've had on your apartment investing journey so far? My just built a brand new 86 unit building, and we talked about, legacy wealth and keeping things forever. That's definitely one that I would assume my 2.5-year-old daughter will be very happy that Dad built that when she was 2.5. So that one turned out great. Brand new ground up construction in the heart of Salt Lake City. What's the best advice you have for someone who's just starting their apartment investing journey? It's a good question. There's lots of advice, but I think one thing that I see a lot of new investors in flipping or any kind of real estate, a lot of times I see the new people, they're really fixated on like entity structure and business card and website and logo and kind of the stuff that doesn't matter. I don't have a website. I don't think I've lost any deals from not having a website, and my logo, I don't have a logo. So I think people are worried about the little things, the fluff, and also on the same note, kind of analysis of paralysis. People are looking and they want a home run. They want, they're looking, I'll get calls and, hey, I'm looking for something that needs to be a 10 cap, man, you're like 15 years too late, that there's no such thing, it's even in the war zone, there's no such thing as a 10 cap around here, so you got to be realistic. And I think people, the analysis of paralysis, and they just, what if, like, there's a point when you got into your first deal. It's not going to be perfect, but you got to do your first deal. So I think too many people wait for the perfect deal. So. Tim, thank you again. I can't thank you enough. You provided a ton of value, a ton of information, and I look forward to connecting with you again soon.
Great. Me too. Thanks for the opportunity. Have a good day.
Hey guys, thank you so much for joining me today. If you liked this episode, please take a quick second and hit that subscribe button. Even better, leave a quick review. This helps our show get found by others and helps us attract great guests as well. So thank you so much for joining me, and we'll see you next week for another episode.